Gold at $4,000. The alert. Nobody wants to hear. Right now, in vaults from Zurich to Shanghai, something is shifting. A number just crossed the $4,000 mark, and the people who understand what that number actually means are not celebrating. They are warning, because this is not a story about gold going up. This is a story about something else quietly going down. And by the time most people notice, it may already be too late to prepare. Stay with us, because in the next few minutes, you are going to see exactly what the world's most experienced investors are seeing right now, and why they are moving before the headlines catch up. Welcome to Currency Arc Insight, the channel built for serious investors, business owners, and the next generation of entrepreneurs who read between the lines before the rest of the world catches on. If this is your first time here, hit subscribe now, because what you learn in the next few minutes could shape how you protect your money for years to come. Before we begin, drop a comment and let us know which city you're watching from today. At the center of the global financial system right now sits a number that almost nobody is discussing the way it deserves to be discussed. Gold is trading above $4,000 an ounce, not $3,000, not $2,500, $4,000. In less than 2 years, the price of gold has nearly doubled, and the people who have spent their entire careers studying monetary history are not celebrating this milestone. They are warning about it. To understand why, it helps to look at what happened just this past week, because the short-term movements tell a story of their own. Silver was trading near $58 an ounce, pulling back slightly after briefly touching $60. Gold was hovering just above $4,000, having crossed $4,100 before retreating under pressure from broader market forces. For anyone watching a portfolio screen, that kind of daily movement can feel unsettling. Prices fall, and the instinct is to start questioning everything. But a serious analyst does not simply react to the number. A serious analyst looks at why the number is moving. This week, the answer had almost nothing to do with the internal fundamentals of precious metals. The real driver was oil. Brent crude pushed sharply higher after attacks on oil tankers near a critical shipping corridor connecting the Red Sea to the Gulf of Aden. That corridor was already under strain from tension near the Strait of Hormuz, and now a second major shipping route was under threat at the same time. The geopolitical pressure on global oil supply was real and immediate. When oil prices rise sharply, the dollar tends to strengthen in the short term. And when the dollar strengthens, gold and silver prices, measured in dollar terms, tend to soften temporarily. This is not a crisis inside the precious metals market. It is a textbook reaction, playing out almost exactly the way monetary history predicts it should. The dollar index confirmed the pattern, climbing meaningfully over several days, and pulling gold and silver lower along with it. But here is the detail that serious observers noticed. In the days immediately before that dollar strength appeared, gold and silver had actually been rising even as the dollar climbed. This is known as decoupling. It suggests that the deeper structural demand beneath the surface of these markets is strong enough to resist even the traditional downward pull of a rising dollar. The pullback that followed was not a reversal of the underlying trend. It was the market catching its breath. This brings the conversation to a voice carrying particular weight in this moment. Robert Kiyosaki, the well-known author and financial commentator, has been issuing blunt warnings again. He has stated plainly that the global economy is heading toward a crash, and he wants his audience positioned correctly before it arrives. His instinct is not wrong, but the analysis needs refining, because there is an important difference between what Kiyosaki is feeling and what the underlying data is actually showing. That difference matters because it separates preparing for the right event from preparing for the wrong one. The word crash suggests something sudden. It brings to mind the kind of visible overnight collapse that occurred in 2008, when a mortgage crisis wiped out trillions of dollars in wealth within a matter of days. That kind of event is brutal, but it is also short. The market falls, the government responds, liquidity gets injected, and recovery eventually begins. What appears to be unfolding right now is something different, something slower, and, in many ways, more difficult to defend against. It does not arrive with a single dramatic headline. It does not trigger panic on one particular morning. Instead, it works quietly, gradually, and mathematically, building in the background for years before most people even notice it is happening. And understanding exactly what that slower force is and what is driving it becomes the focus of what comes next. To understand what is really happening beneath the surface of the gold market, it helps to step back from daily price charts and look at something far less visible but far more powerful. Housing costs in the United States have climbed 50% over the past decade. Food costs have risen more than 30%. These numbers did not appear overnight. There was no single morning when bread suddenly cost 30% more. It happened one grocery trip at a time, one mortgage payment at a time, one utility bill at a time. Most people absorbed these changes without ever fully understanding what was causing them. What was causing it and what continues to cause it has a name. Economists call it monetary inflation, and the mechanism behind it is not complicated, even though it is often kept out of everyday conversation. Governments borrow money. That part is nothing new. What makes this moment genuinely different is the scale of the borrowing and the near impossibility of ever repaying it honestly. The United States currently carries close to $39 trillion in national debt. In fiscal year 2026, for the first time in American history, the annual interest payment on that debt alone will cross $1 trillion. Not the debt itself, just the interest. $1 trillion a year simply to service money that has already been borrowed, already spent, and already gone. The Congressional Budget Office projects that figure will more than double, reaching roughly $2.1 trillion by 2036 in interest payments alone. And that projection assumes interest rates do not rise sharply from where they stand today. The single number changes the entire picture. When a government owes so much that interest payments begin consuming an ever larger share of its budget, the central bank is left facing a choice that is not really a choice at all. It can allow interest rates to rise to true market levels, which would make the debt exponentially more expensive to manage and risk triggering a fiscal crisis that no amount of political messaging could hide. Or it can print more money, keeping interest rates artificially low by buying its own government bonds with newly created currency. That second path expands the money supply and quietly shifts the cost of the debt onto everyone who holds dollars. This approach even has a name in financial circles. It is called yield curve control, and it is not some distant future policy being debated in theory. It is already functioning as the guiding principle behind the monetary system that people rely on every single day. Over the past year alone, the dollar has lost close to 10% of its value. That is not an abstract statistic sitting in a report somewhere. That is every dollar saved, every paycheck deposited, every retirement contribution made, quietly worth less than it was 12 months earlier. Not because of some dramatic visible event, but because of policy, because of mathematics, because of a system that took on more debt than it could ever honestly repay, and chose to inflate its way out rather than confront the problem directly. This is the environment that explains why serious analysts are beginning to talk about numbers that would have sounded impossible only a few years ago. It also explains why so many experienced investors describe what is unfolding not as a crash, but as something closer to erosion. A crash announces itself. Erosion does not. It moves slowly enough that most people adjust their expectations without ever asking why their money buys less than it used to. For the business owner watching costs rise faster than revenue, for the young entrepreneur trying to save capital for the next opportunity, this distinction is not academic. It shapes real decisions about where money is kept and what it is worth over time. Understanding that the ground itself is shifting, rather than waiting for a single dramatic event to confirm it, is what separates those who prepare early from those who react late. And once this mechanism is fully understood, the next question becomes unavoidable. If the dollar is quietly losing value year after year, where is the smart money already moving? And why has one particular asset class begun attracting buyers unlike anything seen in recent memory? Serious analysts are now doing something that would have seemed reckless just a few years ago. They are projecting a gold price of $16,000 an ounce, and they are doing it not with excitement, but with calm, measured arithmetic. This number deserves close examination because it is not built on hope or hype. It is built on pattern recognition. Gold moved from $1,000 to $2,000 over a period of years. It then moved from $2,000 to $4,000. The world is currently living through that second doubling right now in real time. Analysts who study this pattern closely describe it as a doubling sequence, one that reflects how gold responds when the money supply behind a currency keeps expanding with no other direction left to go. If that same structural force continues, the next stage takes gold to $8,000 and the stage after that takes it to $16,000. No government announcement is required to make this happen. No official currency revaluation needs to be declared. It only requires the continued operation of a monetary system that has already committed itself, through its own debt obligations, to creating more currency than it can ever honestly account for. It is worth pausing here to address something directly. When people first hear a projection like $16,000 gold, their instinct is often to dismiss it. That instinct is understandable. Large numbers attached to any asset price often attract speculation and self-interested promotion. But this particular projection does not rely on excitement. It relies on a simple distinction that, once understood, becomes difficult to unsee. Gold does not rise to $16,000 because gold itself becomes more valuable. It rises because the dollar becomes less valuable. The gold has not changed. The measuring stick used to price it has simply grown smaller. There is now a second force entering this picture, one that most analysts were not even discussing 18 months ago. It may be the most significant structural shift in the precious metals market in a generation. Tether, the company behind the world's largest stablecoin, has quietly become one of the largest buyers of physical gold on the planet. Its gold-backed token requires every single unit issued to be matched by a real ounce of physical gold, held securely in a vault in Switzerland. The scale of this buying is difficult to overstate. Tether's combined gold holdings now stand at approximately 154 tons, placing the company among the top 20 gold holders in the entire world, in the same company as recognized national reserves. At the height of its buying activity in late 2025, Tether was purchasing 27 tons of gold per quarter, a pace that, if sustained, would approach 108 tons in a single year. To put that in perspective, central banks around the world are expected to purchase a combined total of roughly 650 tons in 2026. What Tether represents is something genuinely new in this market. It is not a government or a central bank acting out of geopolitical strategy. It is a private technology company buying physical gold at massive scale, driven entirely by everyday individual investors around the world, choosing digital gold exposure through a simple token on their phone. Every new account opened, every token purchased, requires a real ounce of physical gold to be acquired and stored. Silver appears to be next in this evolution. Several projects are already working toward tokenized silver, backed by real physical metal held in audited vaults. Think about what this actually means for the average investor. Physical silver is heavy, costly to transport, and difficult to store securely. For hundreds of millions of people across developing economies, owning real precious metal has never been practical, no matter how much they wanted that protection. A digital token backed by real silver, accessible instantly from a mobile phone anywhere on Earth, changes that equation entirely. The potential demand emerging from South Asia, Southeast Asia, and Africa, regions where physical ownership has historically been out of reach, is enormous once this shift is taken seriously. And this new wave of demand is only part of a much larger story now unfolding on the other side of the world. While Western financial media remained focused on daily price swings, a much larger structural shift was taking shape on the other side of the world. One that received almost no meaningful coverage, despite carrying consequences that could reshape precious metals pricing for years to come. China made a move that deserves far more attention than it has received. The Chinese government implemented a significant restriction on domestic retail investors, no longer permitting them to buy or sell paper gold or paper silver. No futures contracts, no derivatives, no paper positions of any kind, only physical metal, real gold and real silver, held directly or delivered to a vault owned outright by the investor. This is not a policy discouraging precious metals investment. It is a redirection of it, a deliberate government decision pushing hundreds of millions of Chinese retail investors away from paper proxies and toward the physical market. Applied to the world's largest retail investor population, the implications of this single policy shift are difficult to overstate. This connects directly to something that has been building for years and is now approaching a turning point. The price of gold and silver in modern markets has largely been determined not by the physical supply and demand of the actual metal, but by paper contracts traded on exchanges in New York and London. Enormous quantities of gold change hands on paper without any physical metal ever moving. Critics have argued for decades that this system allows the price of gold to be held below what genuine physical demand would otherwise produce. Whatever position one takes on that argument, the structural reality is now shifting in ways that can be measured and observed directly. China, India, Russia, Singapore, and Hong Kong are all building or expanding their own physical precious metals markets. The era in which a small group of Western exchanges determined the global price of gold through paper transactions appears, by every available measure, to be coming to an end. And then there is oil, because the oil story and the gold story are not separate. They are connected at the root by the same underlying dynamic. United States crude oil inventories have fallen to levels not seen in 45 years. Energy markets around the world remain under pressure from geopolitical disruptions with no clear near-term resolution. The Strait of Hormuz remains a pressure point. A second shipping corridor near the Gulf of Aden has now become a pressure point as well. Oil is not simply fuel. It is the foundation of the entire global supply chain. Everything manufactured, everything transported, everything packaged and delivered depends on it. When oil supply tightens and energy prices rise persistently, inflation does not stay contained within the energy sector alone. It spreads through every layer of the economy, accelerating the same monetary pressures already in motion and pushing capital toward the asset class that has preserved wealth through every major economic crisis in recorded history. Consider where capital is currently concentrated. Gold mining stocks as a share of the S&P 500 stand at roughly 0.2% today. At the peak of the last major precious metals cycle, that figure stood at 2%, 10 times higher than today's level. That means gold mining stocks would need to outperform the broader market by a factor of 10 simply to return to where they once stood historically. The combined market value of every gold and silver mining fund in the United States totals roughly $365 billion. A single technology company that manufactures phones carries a market value approaching $5 trillion, nearly 13 times the entire gold and silver mining sector combined. That company does not mine anything irreplaceable from the earth. It does not produce a finite, historically proven store of value. It sells products that can be redesigned, copied, or replaced by the next generation of technology. Gold has served as a store of value for 5,000 years, and by every historical measure, is positioned to remain one for a very long time to come. The gap between these two valuations says nothing about what gold and silver are actually worth. It says everything about where the world's largest pools of capital have chosen to sit. And large institutional money, the pension funds, the mainstream portfolio managers, the generalist investors who move markets when they finally act, have not yet made this shift in any meaningful way. When they do, the effect on this sector may be unlike anything most current investors have ever witnessed.